All right. Thank you guys all for joining us today. This is going to be a strategy that we can use in market sell-offs like we've seen, or if you're just even bearish in a particular underlying. Another aspect is if you have a portfolio just full of long stocks, let's say, which a lot of us have, this is a way to add some negative delta to that overall portfolio. A portfolio of long stocks is long delta, which means it's biased to the upside, right? And if you add negative delta to that, kind of neutralizes that and allows you to participate on the downside if there's a market pullback. A couple of things to go over real quick. This is being recorded, so one thing I say before all of these webinars is if you're not very familiar with the strategy and or options in general, rewatch this again, because a lot of the little nuances of this strategy may go by you rather quickly. You may be thinking of a new question or something like that and miss something along the way. So watch it again. First time you learn it, it goes through to your short-term memory. Second time, if you watch it relatively soon after, makes it solidify and go into your long-term memory. If you wait a while down the road, it's kind of like relearning it all again. My name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I've been trading my own money for well over 20 years now, and I'm not here to tell you that I'm going to make you rich or make you a millionaire, but I am here to help you take control of your finances, manage your own portfolio, but most importantly, take control of your own risk. If you have somebody out there managing your money, you're paying that person to do it. And by taking these first steps to learn options and things of that nature, you're on the right road to taking control of it. You're going to make a few mistakes along the way, but I can almost assure you that those financial advisors and things of that nature, hedge fund guys, are making similar mistakes. I mean, we saw Goldman Sachs blow out of their short position in gold not too long ago. So everybody out there is making bad decisions, and sometimes they're doing them for you. Anyway, I've traded most markets throughout my career, even from the Chicago Board of Trade. I've traded everything from stocks, financial futures, commodity futures, and currencies, and options on all of those products, and in all market conditions, as you can see here. I have a disclaimer I got to go over. Any opinions, news, research, and analysis or prices, other information contained here provided by ProTrader Strategies and or associated companies, employees, is for general commentary purposes and should not constitute investment advice or solicitation to buy or sell any of these securities or strategies. The reason why I have to say that is because, for one, I don't know your risk parameters. I don't know what's in your portfolios, and all of these things that we're talking about could be counterintuitive to what you're already doing. So at the end of the day, we're here to teach you how to swim. We're not here to swim for you. And please remember, the past performance of any trading system or methodology is not necessarily indicative of future results. All right, so like I said, this is going to be long put spreads. And many of you guys may know that I like to collect premium. If you watch the daily market commentaries and stuff like that, a vast majority of my strategies are to collect premium. But we're in this really low implied volatility environment, and it's really hard to find something that doesn't have an earnings that you can sell high implied volatility and collect a nice premium for that. So this is the perfect environment to start adding in some debit spreads, if you will. And when we're doing a long put spread, it is going to be for a debit. And what we're going to be doing is buying. The general thought behind buying a long put spread is to buy the in-the-money put or buy an in-the-money put and then selling an out-of-the-money put to help finance that. You're not going to finance all of it. It's still going to be for a debit. But I actually tend, because I am usually a little bit directionally biased, I feel that when I usually look at a stock and I'm going to implement this strategy around it, I'm pretty biased to one direction or the other. With the put spreads, I would be directionally to the downside in something. So I kind of like to pick the one that's a little bit just maybe out of the money or right there at the money as the put that I'm buying. I'm paying a little bit less for that strategy. It's going to be basically you're buying all extrinsic value, where when you're buying the in the money put, you're buying intrinsic and extrinsic value. And if you're not familiar with intrinsic value, the intrinsic value is the difference between that strike and the actual price where the underlying is trading. And the at the money or just out of the money, you're paying all extrinsic value, which is really time value, and a little bit of volatility. But with this one, I want to stay away from the volatility aspect in these premiums. So the put spread is also known as a bear put spread because we're directionally biased to the downside, or a debit put spread. And like I said, we're going to be bearish to slightly market neutral, mostly bearish though. And when I mean by market neutral is it's going to still trend down, but it's not going to have a violent move necessarily. All right, so with this, like I said, a debit spread, you're always going to be paying a premium for it. One thing we got to look at is time decay, which is theta. And theta is the component that affects the extrinsic value of that option. So as time goes on, it decays that extrinsic value. So we don't want to have a lot of theta or time decay in these options. And volatility. When we're looking at this strategy, we have to consider volatility, and we're looking at it in a low volatility environment, and we want that to expand, because when volatility expands, it not only increases the premium because of that fear that goes in there, people buying up these puts to protect their downside in their portfolio, but it also holds off time decay. It keeps time decay from happening a little bit there. So it kind of staffs that off, so we're not going to see as much decay happening to our premium. If we were to do this strategy in a high implied volatility environment and that volatility comes out, the premiums dwindle rather quickly and that theta tries to catch up with itself and really decays quickly. We don't want to see that. We want to be able to hold on to our premium as long as we can. I'm being asked what strategy would I use if I weren't directionally biased. I would probably start implementing a variety of different strategies. I might end up doing this as an iron condor from the long side. Last week we did the long call spreads, and this week we're doing the long put spreads. One thing that I looked at with a couple of these is you could also do it somewhat as a pairs trade. For instance, most of the casinos right now, a lot of them have come out with worse than expected earnings, right? Let's say MGM and Las Vegas Sands have seen a bit of a downstroke in their expected earnings, whereas Wynn came out with something with a bit of a better than expected earnings. So in a sense, you could do the call spread, long call spread with Wynn, and do the long put spread with Las Vegas Sands maybe, so that you might be able to offset that in a sense. But otherwise, if I'm not necessarily directionally biased on this underlying, then I would probably try to do it as a long condor. But Trevor, to answer your question, I generally don't do long condors, to be quite honest. But that's not to say that you couldn't. But with a long condor, you're may not be directionally biased one way or the other, but you're expecting a rather big move to happen in one direction or the other. So you need to still have that big directional move. You don't want this to trend sideways at all. All right, so the essentials to picking, or to success with this, picking the right strikes. Now, what we're doing is we want to have the strike go into the money that we're long. We don't really care if the short strike goes into the money, because then we're at our max profit. but we want to make sure that we're not picking that put that is slightly out of the money, too far out of the money, where the probabilities are that it's going to be rare that it goes into the money. We want to make our probabilities successful in that we are going to have at least our long put be in the money going forward. Picking the right duration. Now, this is a bit different than what I normally talk about with when I'm selling option strategies. I want to get into this area because, as you can see, as this goes down, that's the theta decay or the time decay picking up rather quickly. So as you can see further out in time, that theta decay doesn't happen quite as fast. So I like to go outside of the 45 days that I normally pick for selling strategies for the strategies that I'm buying, because I don't get that theta decay. It also gives me a little bit longer duration in order to be successful with this strategy. We can pick a number in here, and hopefully it gives us a lot more time to be directionally correct and or to have volatility increase during that time. And picking the right environment. Now, I've touched on this a few times. The theta, which is the time decay, is going to be very important. We want to be able to keep theta from happening, but we also want to have this have low implied volatility, because we don't want to buy this in a high implied volatility environment and be directionally right, but that vega or that volatility coming out of those premiums would really offset the gains seen on the upside. That can happen a lot when you're buying options. If you buy them in a high volatility environment and volatility comes out of those, you could be directionally right and still not see your premiums decay the way that you would hope. And we need to pick the right underlying. And I talk about this time and time again. When we're doing this with this strategy, the right underlying is something that, you know, is traded a lot. You know, even some of the underlyings that have a lot of volume don't have a lot of options volume. So we want to look at the options chains in the underlying that has a lot of participation in there. And the reason why is something like Apple, that's a $100 stock, you can have as tight as like 1 or 2 pennies wide, whereas you can have another stock where it could be, let's say, an energy stock or an energy stock may not be necessarily the best, maybe a Pfizer or something like that, where the bid ask on that is going to be 15, 20 cents wide. The reason why it's important to stay away from the ones that are, you know, over 20 cents wide or so is because you have to give up 10, 15 cents sometimes to get in, and then you're having to give up another 10, 15 cents to get out. That's about 30 cents. Now, that's quite a bit, especially when we're talking about a strategy where we may be only collecting $1 for. So you're going to be giving up a lot of premium to get in and out of those strategies, and that could really eat into your profits. Whereas if you're picking something that has a really tight bid ask, you're not giving very much up to get in and get out. Does that make sense for everybody there? All right, good. And know your exit strategy before entering the trade. We talk about this time and time again, even with the short collecting the premiums. With this one, we are going to be looking at getting out if we start losing about 50% of what we paid for it. So if we paid $1 for it, I like to get out when it's not going my way right away, and if I see my premium decrease by about 50%. So if I paid $1 to get in and it's at 50 cents, usually that's going to be a time that I start doing a little soul searching on that and say, you know, it's time to rip the Band-Aid off. Let's get out of this strategy. The other thing is, you know, if I paid $1 for it, I'm usually looking to double my money. So if it's, say, a $3 wide strategy, or yeah, about a $3 wide strategy that I collected $1 for. I'm usually looking to get out at about $2 on that. So our max profit on this strategy is going to be the long put strike minus the short put strike minus the net premium that we received. So if the difference is, if we're buying an underlying that's trading, let's say at 50, just to make math easy, and we're going to be buying that 50 put, and then we're going to be selling the 45 put to collect some premium for that. If we say collected $1.25 for it, our max profit is the difference there, and that is $3.75. In this case, when I was talking about know your exit strategy, I would probably be looking to get out when this had made about $2.50. So what I doubled my premium that I paid, that's usually when I'm looking to get out. And the reason why I like to get out early and don't like to ride this all the way into the sunset, for one, you don't really want to take this all the way because you're going to start seeing that theta happening. And the great thing with puts is when the market goes down, volatility generally spikes up. So you could see this if the market starts coming off in our direction and volatility goes up, we get double bang for our buck because the volatility is going to help increase those premiums quickly, and we could start seeing our profits happening much quicker than just what this formula here shows. Because remember, these formulas are going to be what happens at expiration for the most part. I don't know if I did mention this, but yes, this is being recorded. So if you're new to these strategies, please watch them again. Also, max loss is the net premium we paid. Anytime you're doing a debit spread or you have to pay for an option strategy, you guys, that is the most you can ever lose. You can't lose anymore. And our break even is going to be that long put strike minus the net premium received. So if we paid $1.25 for that 50 put, then remember our break even is going to be when the underlying is trading at $48.70. That's when the underlying is trading $48.70. We are basically at our 75 cents. I'm sorry. We are at our break even on that. All right, so enough with the boring slides. Let's get into the overall platform. And this is usually where I tell you guys, please start throwing, if you guys are, we're looking at directionally to the downside with these particular underlyings. So let's start looking at some things that we would be bearish in. I was kind of flipping through some, and this is limited brands. I haven't looked at them very much, but I did see that they were down quite big over the last couple of days because most of the retail sectors here and abroad have been really doing rather bad in this environment. We're just not seeing a lot of good economic data, and it's being reflected in some of the earnings, especially in these retailers. Goldman Sachs, good call, Nick. That was another one that I was kind of looking at, is also down. Trevor's asking, does the break even also include commissions? I did not add in commissions there, but yes, you do have to take into account your commissions paid for that. That will also decrease your break even by a little bit. Everybody's commissions are a little bit different, so you're going to have to take your own break even or your own commission prices into that, and make sure when you're doing that, you want to kind of account for when you're getting out also, because with this strategy we aren't really looking to get out of this at expiration or let it expire at expiration, so we are probably going to have to pay to get out of this strategy. So please take that into account as well. Great question, Trevor. I should have mentioned that. All right, so the retail sectors, like I said, so something like limited brands right here, trading $70. Everybody's heard of limited, but as you can see, $70 it's about 15 cents wide. You get into the money and they start really getting pretty wide. That's another reason why even some of the more popular like apples and things of that nature, when you get deep in the money, you can see that these really get wide. And that's another reason why I don't like doing this strategy as the in the money. A lot of people like to try and pick about the 84 delta or so, which gives you a strong probability of being in the money, and you aren't paying a lot of extrinsic value. A quick cheat to see how much extrinsic value is embedded in the options that are in the money, rather than taking, okay, 60 minus 69.50, $9.59 minus this. There's, you know, mid-market is right around, you know, and going through that whole step of figuring out what the extrinsic value. A quick cheat is look straight across, and that is very close to what you're paying in extrinsic value for the option over to the side of it. So always keep that in mind, or that's what you should be paying as extrinsic value over here. So don't give it up much more than what you would see over here, because then it doesn't make sense for you. Oh yeah, and Limited Brands is has an IV of above 50. I want this IV to be well below 30 and in the teens if at all possible. Good point, Trevor. And the reason why it's really getting jacked up is because of this. Anytime you start seeing the massive sell-offs, people are buying puts to protect their position. Great point, Trevor. All right. The idea is, no, so I would discount this. I would look at it, you know, that looks like a great direction. I think it's going to head down. We also have earnings coming in. I really don't want to take this into earnings, although, you know, you probably will see IV continue to ramp up going into that. I just don't want to mess around with that right now with this strategy. So Nick, I think it was, asked about Goldman Sachs. So let's look at Goldman Sachs. I've got the Merritt Islands in Florida. Somebody's in here from. Good to have you. Anyway, so Goldman Sachs has been in a downtrend. It has bumped up against this 50-day SMA, but you know, if interest rates aren't going to be increasing, we got some mixed results from some of the different Fed governors out there. Some of them are saying 3 still in 2016, and some of them are saying they're data dependent, and some of them say that they don't think that we're going to. So I'm in the camp that I don't think the economic data, the GDP numbers and everything else are going to really push these guys to start raising rates anytime soon. So it's going to hurt the overall banking sectors and or the Goldman Sachs of the world. So this would be a pretty good candidate. It looks like they have pretty low implied volatility. They did just come up with earnings and beat, but you know, I think the expectation is that they could go down. So looking at Goldman Sachs, you know, it's a $150 stock with 10-cent wide, and in some cases, a lot of times they'll be even tighter than that. I mean, you can even see 6 cents wide. Deeper in the monies are going to be a little bit wider. Again, you know, some people pick this 84 strike to decrease the amount of extrinsic value that they have to pay. But as you can see, you're getting taxed on a 50-cent wide bid ask. So, you know, at best you might be able to pay $15 for this, for the 145 strike, and you know, that puts you right there at around what you're paying for extrinsic value to make it right. But not necessarily. You know, when you go to get out of this, if you're even more directionally right, you can see the deeper in the money these get, it's down to $2 wide. So I would rather only have it go a few dollars into the money and, you know, be at my max profit before it gets deep in the money. Does that make sense for everybody? That's why I kind of, if I were going to, and I'm looking at the calls, I'm sorry, I have a tendency to always look to the calls first, the puts over here. But the same thing you'll notice on the puts, the deeper in the money you get, you're paying less in extrinsic value, but the bid ask is getting further and further away. So if we were to look at trying to get out of this early, maybe we were even at our max profit and look to exit it, we're going to be looking at giving up a lot, or possibly having to give up a lot to get out of this strategy, despite the fact that they have a lot of volume and open interest, as you can see here. And again, I'm looking at the 42s, which is probably at that time where we're going to start seeing a lot more theta decay happening, and these 45 days to expiration. As you can see here, the theta is about 7 for those, and if we go out to the 70 days, our theta is only about 5. So that is how much is going to come out of the premium per day, 5 cents per day versus 7 cents per day. It doesn't seem like a lot, but that does have a tendency to really start increasing quite a bit. And what is it? Nick's asking, would I do the 160s? Yeah, I wouldn't have a problem doing the 160s, being slightly, those are as true to or as close to at the money as you probably could get, even though they are in the money. It's closer to being at the money than the 155. So for sure, I would look at doing that. But generally, I usually pick the one that's right out of it, just being one that doesn't like to pay a lot for any type of strategy. So I would probably default to the 155s. That makes sense. Why did the in the money have wide bid-ask spreads? There's John, and is that due to lower open interest? That doesn't usually give you an indication of open interest necessarily. It's just as you can see here, these have just about as much open interest as these do. I mean, give or take. These on the call side don't, but that's a great question. I think it's basically because a lot of people don't like doing the ones that are in the money necessarily. So I would probably start off buying the 155s if I were to do this one. And I am bearish Goldman Sachs, so I would definitely look at doing something like this. So then I would start looking at, I want to get about a quarter to a third the width of the strike. So in that, if I was doing a $5 wide, let's say a $3 wide, just for math purposes for everybody, then a third of that would be $1. So if I was doing a $3 wide, I would try and collect or pay no more than $1, and keep that between $1 and what is 75 cents. So 75 cents being a quarter of the width, and the dollar being a third the width. So that's my goal on this strategy. So in that, a $5 wide one, I'm going to be looking at going about $20 wide. So I'm going to be looking at doing about the 125, or sorry, I have a worker here, and my dog is saying hello to him, I guess, and that could be a little annoying. Sorry, you guys. So selling, what did I just do? All right, so we're doing the 120, so $20 wide would give me the 135, so $4 is, that's closer to the quarter, the width, so that's right in line with this strategy. So we're trying to get at least a quarter of the width to a third the width. And you can kind of play around with those. It's a little bit more difficult with the $5 wide, but that's something I would look at doing. And like I said, your max loss on a one lot here is going to be $424, and then we can figure out our max profit by taking the $20 minus the $4. So our max profit is going to be $15.75, right? Now I'm going to be looking to get out of this once it's around $8, or if it goes down to $2. That does sound like hello. Yes, it sounds very annoying though right now. This strategy can use the weeklies or monthly expirations. Yes, absolutely, Trevor. You definitely can. Like for instance, especially with Goldman. Now make sure that it's going to be something that has a lot of open interest, like Goldman does. They have, you know, a lot of contracts being traded. But remember, you know, the weeklies that are further out are going to have a lot less participation. So, you know, the difference between these weeklies, which is going to have a lot higher theta component, you know, 9 cents a day, if you want to get outside of even just from the 45 days, you know, which is the sweet spot for selling strategies, then you can see it is, I don't know if you can see that, you know, you're paying an extra penny a day, or only saving a penny a day for 7 days duration. Does that make sense? So for me, you know, and they usually don't have the weeklies really far out, but if you're trying to get out there, it seems to me just to go to the monthlies. And, you know, I like with this strategy around 70-ish days, you know, between 70 and 60 days is kind of the sweet spot for me for these. Does that answer your question? All right. So that would be something that I would look at. You know, you can always double check the math. $424, like I said, max profit is going to be the difference between that, which is right around $15.75. Okay. All right. So you guys start throwing out some more. We'll look at one that I was looking at, which was Las Vegas Sands, just because I have I mean, I don't know if it's necessarily true, but in general speaking terms, I've noticed, in my eyes anyway, that I think that when stocks have a tendency after earnings to start slumping, they continue to slump. And being a contrarian, it looks like, you know, hey, it looks like somebody tried to take advantage, push this up, stopped at basically yesterday's high for the most part. It might be a good time to add this on. You know, I don't really want to sell this after, or sorry, I don't really want to buy this put spread after the market's had a big down day. The reason why I don't want to do that is because everything has a tendency to get a little bit of pop back. So I like to have something that I'm pretty bearish on and wait for that nice up day and then implement that strategy rather than on the big down day, or after, I should say, after that big down day. I like to have at least see a bit of a rebound before, you know, the ball drops again. So this would be something that I would really like to look at. And, you know, it's a $50 stock. It's inside of 10 cents, which I like to have my strategies or my underlying have less than 10 cent wide bid ask on something that's under $100. Now, of course, you know, like the Amazons and things of that nature have a lot wider bid ask, but, you know, a lot of times with those bigger ones, even though the bid ask is pretty wide, you can almost assure yourself that you're going to get filled mid-market. So if it's, you know, $3 wide, you know, the mid-market is $1.50, you know, you can almost consistently get filled within 2 or 3 cents of that mid-market. So keep that in mind. Sometimes they seem very wide, especially on some of those high flyers or even like the Teslas. Then you can still have a tendency to get filled mid-market, and that really has to do with like keeping track on a piece of paper and or just trading a lot and being involved. So moving on with this one, you know, the $45 one is just outside of the or out of the money. But as you can see, being up $1, it was in the money yesterday. So could be a good time to put this on, like I said. So I would go to the $2.64, and I would look at something like, all right, I'm going to probably able to finance at least 64 cents of this, because that's usually what I'm looking at. So $2 wide, you know, I'm looking at least $6 down, right? So the 39, so that kind of really puts us right there. So that gets us that third the width of the strike, and you know, gets us right there at around $2 that we're looking for. Again, I'd look to cover it at $4 or at $1 on the downside. So you know, you're making $2 to the upside or losing $1 to the downside to keep that consistent. All right, a couple of people are throwing some other ones out. Let's look at, just go down the line for people. DDS, Dillards. All right, so you know that they aren't going to have that strike I'm looking for with the 70 days to expiration until these go off the market. So you'd have to default probably. I would probably look to default out 100 some days, which isn't bad necessarily. As you can see, it's 40 cents wide for the 40 cents wide on the bid ask, 20 cents wide there. That seems probably a little odd. Maybe it's because it's on a Friday and some people pulled their trades on that. Let me close that because that could be confusing to some people. So I don't trade Dillards very much, so I'm not very familiar if it gets traded a lot. We look at the volume and open interest and just see if there's a lot of participation in there. There was in the calls, or actually it wasn't any in the calls even, but we're pretty far out. So I might, if I really was bearish Dillards, you know, you might go into this. I don't know that I would necessarily. I'm going to pass on that for right now. Dillards also has a really high implied volatility, 75%, which, you know, that in that case, if I was really bearish, I might even look at selling a call spread on that, just because you got the high implied volatility, which is going to pump these premiums up. So I would probably default to looking at selling a call spread in Dillards. I don't have the time to go into the rules of selling strategies right now, but I have done webinars on selling calls and call spreads and stuff like that too. So you can check that out at Pro Trader Strategies. So yeah, there's just too many variables there for me to be implementing this strategy with Dillards. All right. So on to Walmart. It's the next one down the line. Walmart is above 30, you know, and they have the earnings coming in. So one would believe that these are going to start ramping up as we go along. So I would probably bypass that one again. IBM is another one. Sorry if I didn't get to some of yours. Some of them are rolling off the screen as we talk. So IBM, you know, from a trading standpoint, you know, I think they beat earnings and still are selling off, right? Yeah, they did. Tried to come back, failed again. It's got a nice up day, so I'm not necessarily bearish. And part of this upstroke, I don't know if many of you guys saw that article, but Warren Buffett basically said that he has never sold a single share of IBM and plans on adding more to his portfolio. So that could be one of the catalysts for making IBM have that rally today. I think that came out yesterday. A couple of questions coming up. Where are you seeing implied volatility? Great question. This blue line is implied volatility, and the purple line is historical volatility. Historical volatility tells you where volatility has been. Implied volatility tells you where volatility is expected to be. in the future. Now, of course, they don't really know, but this is implied volatility. And when I'm talking about this number down here at the bottom, which is actually the implied volatility percent, which is 19, which is very low for IBM, which is good for this strategy, I should say. But the way that the algorithms determine what implied volatility is for IBM, as you can see here, I have it on my watch list. It's 18.88 because it's taking it out to the hundredths. But, you know, the quick way to figure out what implied volatility is, and you guys should know this as well, or the implied volatility percent is, I should say, is you have a numerator and a denominator, and on the upper portion of the fraction, the numerator, you subtract where current implied volatility is, which is, say, 21, just for math, and you subtract that from the low, which is somewhere right around 5, let's say. So in the numerator, your total is 15. And then in the denominator, which is below, you subtract the high, which is 94, let's say, from the low, or let's say it's 95, and subtract that by 5. So you got 90. So you have 15 divided by 90. Right? So that puts you right there at around 20%. That's us just ballparking it, right? And that's pretty close to that 18%. So that's how the algorithms come up with it, and they obviously go out to the hundreds. One reason why it's really important to understand that number is sometimes you'll have something with a low implied volatility, and you'll have a massive spike that goes out of the range for no apparent reason that you really know of. And if you wanted to smooth that out a little bit, you could take that out of the equation, being like, all right, well, the high implied volatility is usually actually around 76, you know, and then use that as your high. And there's nothing really wrong with that, because sometimes you do get anomalies where they spike out, and I don't really have a problem with smoothing that out a little bit if the high is usually generally right around, let's say here, the 75, 79-ish area, say 79. Does that make sense? Yeah, Barry, this is being recorded. Is this part of the toss indicator? I don't know if I think other platforms probably have implied volatility. It's pretty widely used. For this strategy, don't you want a ramp up in volatility? Absolutely, Trevor. I mean, it doesn't hurt us if we are in the teens and implied volatility goes down a little bit, because it's not really going to go much lower, maybe 8% or something like that on the high end. But, when you're doing something with like a 75 or 50, I mean, that can go down to 10, and that's 40 percentage points. And one nice thing with toss is, what was that one that we were looking at that had high implied volatility? Was that I want to say Lulu, but it's limited. So one thing you can do with something like this is figure out what would happen, because 57. What was the one that had higher implied volatility? Maybe it was what was Walmart? 43. Who else had? Somebody had 75 or something. So Dillard's. Okay, so Dillard's. Let's just look at this. So the reason why you don't want to do this, you can go up here. One nice thing about toss is you can go up to theoretical and market. All right. So, and then you can play around with these numbers here. So let's put it to today. So let's look at this. So we are bearish in Dillard's, okay, and it's trading $67. We buy the $65 or the 65 strike, right? All right. So let's just say, only a few days go by, so we know we're getting theta decay happening here. But now let's say the stock goes down by, let's say $3. Okay, but our implied volatility goes down by -30, okay? Because that's going from 75 to 45, which is realistic. I mean, a lot of these are in the 40s, right? It's one of the few that's out of there. And we hit enter. So our theoretical price on this, wait, did I, oh, it didn't give me the negative, sorry, I went up by, so let's say it goes down by $3. So we're starting to get our directionality that we want. We could even say maybe $5 just to get a little bit more wiggle room. So it goes down by $5. As you can see that this strike is now in the money right here. We paid $4 and let's just say somewhere in between there, but now it's lost a whole dollar just because of that theta coming out of there. So the market would, so we lost $1.50 and we were directionally right. We should have been able to gain money, but because it went down, we could probably even say that big of a move. I mean, we could probably say it went down 7 to where should be $5 in the money, right? It should be trading around 60 if it goes down that much. And look at that. We made only 20 cents and we had a $5 move to the downside, but because that volatility came out, it hurt us. So we're directionally right. We should be deep in the money for the most part, past our break even, but that theta component really hurt us. All right, so keep that in mind, and you guys can play around with it. I suggest that, but that's the real important reason why we don't want that theta, or sorry, that volatility to collapse on us. And if it's already collapsed and we're down here in the teens or under 30, it doesn't have that far to go. Can't go, it's not going to move that much. The probabilities are that it's going to go up for us, if anything, if we start getting our move. Okay? All right, great. So yeah, so that was just an example. I wouldn't use this. That was an example of why I wouldn't use this one. I can be directionally right, but that theta is going to crush me. Or the volatility coming out allows all that theta to come out, and that's what really would hurt. Okay. All right, so Microsoft, that's a good one. Microsoft has a lot of open interest in volatility, a lot of open interest in volume. Volatility is real low, and they were another one that, yeah, I mean, came in line. That was a pretty big sell-off for them coming in line. So if we're bearish them, one thing I mentioned with the calls is you don't really want to be doing buying calls when you're going into the dividend because they take it out of it. It doesn't really affect the puts as much as it does the call. And when you're doing call spreads, it's kind of offset. But anytime you're buying calls and you got a dividend coming up, you can be hurt by that. So just always be aware of that with calls as a side note. But it doesn't necessarily affect you as much with the puts. Sometimes it can even help you. All right, so Microsoft is a good candidate, low implied volatility, and I already have a position in here, which I did for the call spread webinar. So I would be kind of bullish on that, but having seen this chart from a week ago, we've only gone sideways. So you could do something like that, like create a condor around it, or even an iron butterfly. So in that regard, if we were going to do it with this, I don't know that I would necessarily build this out to make it an iron butterfly, but definitely could. So I really don't have an assumption with them. And so you're buying the 50 strike, and just to keep it consistent, I went $5 for this one, so I would probably go $5 this way, and $1.35 for $5 wide. That's right there within the wheelhouse of acceptability for the quarter of the width, right around there, close to it anyway. So yeah, so Microsoft would definitely work, and that's how I would kind of build that out. I look at it, figure out what I can get paid for it, and Now in this one, I would have created, this is a directionally bearish assumption, right? But, having seen Microsoft go sideways, I might add this into it. And it would create an iron butterfly, a long iron butterfly. So now I'm just hoping any move in any direction, that's going to be big. So if that were the case on something like this, now I'm just looking for it to move in any direction and have no assumption whatsoever, or just have no idea, and I had created an iron butterfly. Because an iron butterfly is a straddle with wings. The base, it's the idea of a butterfly has a big base and then wings that are pretty far out. Okay, so let's look at a couple other ones that I was looking at. So I was even looking at Tesla. So a lot of people are really getting bearish on Tesla because of the production schedule that they have for coming out, that Elon Musk is basically firing everybody, and attrition rates are pretty low there and everything else. So if you're bearish Tesla, as you can see, they've been taking a pretty big hit. May have already overseen it, but you get a couple of days up. It's gone below the SMA, which is pretty bearish for it. As you can see, what was Tesla's IV percent? 22, so that meets the parameters. If it continues to go down, it's going to see, as you can see, when the market goes up, volatility usually goes down. So we want this to go in our direction too. So, so Tesla would be a candidate. As you can see, the 210s were just in the money, and they would be out of the money now. They don't have, I'm surprised they don't have the July ones in there. All right, so anyway, so the 210s were in the money yesterday. They're out of the money today. And it moves quite dramatically. And this one, if you're like really bearish, I have no problem with you going down a little bit further to a little bit further out of the money, because this right here, the delta for one tells you how much $1 move in the underlying will affect this premium by 41 cents, right? It also gives you a little bit of I don't know what the way to say it is, but something we used to use on the floor was, double the delta is your probability of touch. So the probability of these 210s being touched or going into the money, within the next 100 days is 82. Excuse me. The delta tells you what the probability of these being in the money are at expiration in 130 days, which is only 41%. But the probability of touch is double what the probability of it is to be touched or to go there and go into the money. Maybe for just a day or two it could, but that's the probability of touch. And the same thing with even further out of the money, the probability of Tesla going down and testing or touching $170 is about 40%. Okay, so that's something to keep in mind. Now, because Tesla is such a high flyer, to do the math on these rather quickly to get how wide we want, we're talking 50 some odd dollars wide in order to get that, how much we're paying for this and how much we want to make, right? We want to at least be able to make $40, so we want it to, so it's going to have to be around $60 wide. So we're going to be picking the 150s probably to sell. You guys kind of went through that math kind of fast because I did it in my head, but it's ballparking really. If I figure if I have to pay $22, I want to make $40 on it, right? So that puts us at $40 already. and I don't want that necessarily to be my max profit, so I usually multiply this by 3-ish. So that would put it around $66, maybe $70. So I could probably even go down here further and get it a little wider. But, you know, 150 seems like a good place to do it. You can also go down here and check it, you know. 150 is way down here. Is it going to go down there and test it? It very likely could. So that might be another reason to go down there and go a little further out in time. But, you know, somewhere I would pick between the 150s and the 140s on this one. I was bearish on it. Does that make sense? On that one? All right, so on to the next one I was looking at. So Tesla, and so I'm kind of bearish. The retailers, like I said, Macy's is one I think has been going down quite a bit. They have kind of found support here, but the retailers in general are hurting as far as I can see, and it hasn't had that big move. It does have earnings, so it might be something I'd stay away from then. So I'm going to look at, and one that I did do today for the, how much do you lose if it goes up on Tesla? You would lose the amount of money you paid for it. So in that example I looked at, it was a $17, so you would lose $1,700. So, you know, depending on your risk tolerance and how much money you have in it. One thing I also always say and I haven't said this in a while, and I've been meaning to, when you're looking at building a strategy and implementing it into your portfolio, don't allocate any more than like 5% of your portfolio to any one underlying. All right, so does that make sense? Yeah, so you lose 17 to make 40, or lose 17 to make, it would be 4,000. Because with options, every one line you add 2 zeros, it's worth 100 of the underlying, so you add the 2 zeros. So you lose 1,700 to make 4,000. So, but don't allocate. So 1,700. So if that was 5% of your portfolio value, you know, yeah, 2 to 1 ish is what I'm looking for. And you know, your max profit on it would be like around 6,000. So don't allocate any more than 5%. So, you know, doing this strategy, 1,700, you're going to have a pretty big portfolio value in order to have that be below that 5% of your overall portfolio. Does that make sense, you guys? Because that's really important. Last thing I want you guys to ever do is go out there and implement a strategy that is taking up 50% of your portfolio value. That's just crazy. I don't care how sure you are of the directionality, don't do it, because there is a very good possibility you're going to lose money on it. So don't allocate more than 5% of your portfolio to any one strategy and any one underlying. Okay? So Macy's got it coming up. So TJX. Oops. TJX is the last one I'll look at. And I don't even know if I've ever even traded this one. Somebody's asking about it. But 15 cents wide, $75. I mean, that's right on the cusp of it making it. You know, if I was really bearish this one, you know, I usually say 10 cents in below $100. It's got to be 10 cents wide. This is 15 cents wide. Might be able to bend the rule there if I was really bearish on it. I'm not necessarily, but if you are, I wouldn't hate it. I mean, it rallied up and tried to test this 50 SMA and really kind of failed on testing it. So you might very well want to short that one. But yeah, I didn't look at the IV. What's the IV on it? 31. So I'd be bending a lot of rules there. I'm going above 30, which I necessarily wouldn't want to, It's 15-cent wide. That's bending another rule. I don't know. I might pass on that one. And do they have earnings on top of it? Yes. It would be out the door on that. So the ones I'm going to probably look at are, so I wanted to show you guys the emerging markets ETF, which is EEM. And I did this, and I did it in the daily market commentary today. So I did this strategy here, threw it in here too. And so the 130, so as you can see, the ETFs a lot of times will have tighter bid ask also. And where is it? 19%, so it's below 30. And if the overall economy is not doing very well, retail sales aren't doing very well, these emerging markets are going to be struggling. So I went in to buy the 32.5 calls and selling the 28 calls. I think I did it for like $1.10 or something like that. I paid $1.10-ish for it. So that was an example of that, because I am bearish the overall emerging market sector. We've had a big sell-off. It went below that SMA. It's looking pretty bearish to me. It's, and usually in a bull market, you see higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, and then all of a sudden we got a high, and then it failed a little bit, and now we've gone below this low here, right there at it. It's looking pretty bearish to me. When I was looking at it, I thought for sure it was going to go below there today, but we did have a big market up move, so pushed higher. All right, did I answer all your guys' questions? Does anybody have any last minute questions for me on this? All right, good enough. I want to thank you guys all for joining us Friday after the close. I'm sure everybody's ready to get out of here and do whatever you do on a Friday night, but we got to throw this out there. In the chat box there's a link to this, so you guys don't have to try and write everything down. But this is a premium trial offer where you get the daily market commentaries, and I suggest everybody watch those daily market commentaries, you guys. I'm going over everything I'm doing, and why I'm doing it, and I kind of brush upon the rules a little bit here and there. It gives you a little bit of refresher there. And I talk about the economic, geopolitical, and the things I see affecting the market. So you guys should really watch those, whether or not you believe in that. You can also follow me on Twitter at Wolfman's blog, because like with the earnings trades like GoPro and Yelp, I tweeted those out yesterday at the end of the day. So you can follow me on Twitter at Wolfman's blog. But you also get online access to the lesson videos, which are kind of like these webinars, but I don't think they're as good because you don't get the back and forth, and you guys throw out some ideas for me and we can all go through those together and see if they fit the parameters. Whereas this, I'm just kind of giving a real quick overview of how to do that strategy. And then you get these webinars, which are really valuable, I hope, and where I think you guys will get the most out of it, because we talk about it back and forth. So you can go to protraderstrategies.com and sign up for that. Like I said, that's in the chat box. I also want to thank you guys all for joining us again. And later webinars, we're going to be drilling down on other option components and how to trade options, where I find them and where I think they're appropriate. And please reach out to us at trading@protraderstrategies.com. Give us some ideas. If you guys want to see a particular strategy that I haven't done a webinar on, or maybe I did it, a long time ago, and you want to see something that is more current to what's going on today, then, write to us, tell us. And, if you're a member and you got a strategy that you put on that's going against you, and you want some insight as to what you need to do to get get something taken care of, then, write me, ask me what, I would do. I can't tell you, again, what I think you should do, but I can tell you what the rules that I've come up with would say to do in that particular situation. And it's kind of up to you to pull that trigger. But I would tell you what I would do and how I would either defend it or, or exit it. So please feel free to reach out to me. I'm very good at responding to those. And if you have any questions, you can contact us at 310-598-6677. What is the rule for picking the short strike? Real quick, good question, Michael. What I do is I take what I'm going to pay for that one that is at the money, let's say, and I usually just multiply that times 3. And then I look to try and, so if it's $1.25, let's say, I'm going to multiply that times 3. And usually I try and figure, okay, well, that's going to be about, $5 wide on. So I'm looking for that $5 wide strike then, so that I can double my money on the move that's still within that range. And the reason why I picked the multiply it times 3 is because that kind of gets me that idea of I'm collecting a third, or I'm paying a third the width of those strikes in a sense. So that's kind of it. There's not a real rule other than I don't have a delta necessarily, because the premiums are all going to kind of determine that. All right. Good question. All right. Thank you guys all, and if you can't take that, take it easy. Have a great weekend, everybody.